Good morning and welcome to Financial Accounting. And we are in the fall 2022 semester right now. Today, as you can see on the screen, is Tuesday, November 1st. And we finished up Chapter 9 last class, so the Chapter 9 problems should be submitted in C now by the end of the day. And we'll be covering Chapter 10 this week, so the Chapter 10 pre-quiz should be submitted today. The Chapter 10 exercises on Thursday. And then, as you know, and we'll be talking about this today as well, as you know, this coming weekend is exam 3. So that exam covers chapters 7, 8, and 9. We do have a review session scheduled for tomorrow morning. At this point, I'm not sure how many people might be signed up. I've had some changes, people who had signed up and then were unable to attend, and so they canceled. So I'm not sure if anyone is signed up for that right now. If nobody is there, there will not be a review session. If there is even one person who is there live, I will hold that review session and I will record it. And assuming there is a review session, I will post that recording to Brightspace just like I have the first 2 review sessions. So that's scheduled for tomorrow morning, 9:30 to 10:30. If you do not have a class at that time and would like to join us, please sign up in Starfish and join us on Zoom. If you're not able to attend, hopefully you'll find the review session, assuming there is one, you'll find that review session recording helpful as you prepare for that exam. So exam 3 due on Sunday. Officially, the exam period is Thursday to Sunday as always, but in reality, the Chapter 9 problem is due today. Once you finish all the work for those 3 chapters, you are certainly welcome to take the exam today, tomorrow, whatever day is most convenient for you. It is open at this time, but it should be completed no later than Sunday. And as with every exam, there is a time limit, 3 hours, unless you have accommodations in place. And once you start, the 3 hours starts running and you need to finish within that 3-hour time period. Just as I said with the first 2 exams, if you encounter any kind of a technical issue while you're taking the exam, you need to reach out immediately. Email me so that I can, if possible, help you and get you back on track. Keep going at that time. You definitely do not want to wait until class next week to tell me, oh, by the way, something happened and I couldn't take the exam. You need to let me know right away. And I may or may not be able to fix it right away, but at least you've informed me. Okay. So any questions about any of that stuff that's due this week? Of course, just like with the first 2 exams, the third part of the project is also due. I'm working on evaluating the part 2s right now, so you may see feedback from me today for that part 2. It is what I'm working on, even not during class, obviously, but right after class, I will go back to those. So just like with the first 2 parts, please use the numbering or lettering system, whatever's in the instructions. Make sure you follow that numbering, lettering, so that I can easily identify your answers to each question and give you credit as appropriate. All right, if there aren't any questions about that, then what we are going to do is take a look at first the practice set for the exam. Just like we did with the first 2 exams, there is a practice set. The practice set is not graded. And so to find that practice set, you need to click on the option for assignments I can practice now or all assignments. It does not show up on the assignments I can take now because it is not graded. Again, just like with the first 2 exams, I can see who has worked on the practice set, but it does not directly impact your grade. The practice set, though, is set up with what's on the exam in mind. And so the idea is if you do the practice set, you know where maybe you need to spend some more time studying. or it gives you that extra confidence of knowing, okay, I got this because I know how to do these things, or I know how to find how to do these things. You can see that the practice set has 12 exercises, 12 exercises in there. They are all what the book refers to as brief exercises. So these might take a little bit less time than what the exercises we did in class, but these are more similar to what is on the exam. If we have a review session tomorrow morning, my expectation is we would go through at least some of these exercises from the practice set, depending on how much time we have. The review session is scheduled for 1 hour, and I have kind of a hard stop on that hour because I have a class after that. That new class that I have. So we'll do as many of these as we can. If people are there at the review session, we can jump around with whichever exercises you think would be most beneficial. We may not have time to do all 12 within that hour. And so you can see, as always, the exercises are coded to indicate which chapter where you might find these exercises. So just a couple from chapter 7, because if you recall, there wasn't a lot of doing accounting in that chapter. It was more focused on the internal controls and concepts behind what we do. But you've got a bank reconciliation and petty cash. Chapter 8 on receivables, you have exercises related to using the allowance method, both of the 2 methods that we talked about in class, the balance sheet approach and the income statement approach, analyzing receivables, and then an exercise about notes receivable, calculating interest using the simple interest formula, I equals PRT, finding the maturity value, doing entries related to that. And then in chapter 9, which was the long-term assets chapter, as you know, in that chapter, we covered 3 different types of depreciation: straight line, units of activity, and double declining balance. So there's 1 exercise for each of those to make sure you're comfortable with doing those calculations and entries. We talked about what happens when we get new information and we have to change depreciation partway through the expected useful life of some asset. And we also talked about what happens at the end of the useful life of that asset. So you've got an exercise related to that. Disposing of the asset, how do we do those calculations, and how do we record that in our records? And then finally, last class, we talked about 2 other groupings of long-term assets. We talked about natural resources as well as intangible assets. You can see that in the final exercise in the practice set, this is related to natural resources, calculating depletion, which looks very much like the units of activity approach to calculating depreciation. So that's the practice set. Hopefully you find that helpful. Many of these, if not all of them, have the Show Me How button. All of them have unlimited use of the Check My Work button. If you're working on these on your own and have questions, obviously I would be happy to help with those. Just need to let me know. And then let's go to the exam. So again, the exam has a 3-hour time limit. Once you hit that Start Test Now button, you are committed to maximum of the next 3 hours. This exam has just 24 questions on it. As with the first 2 exams, it's a mix, you can see, of multiple choice and exercises. Multiple choice in general, I expect you can read the question and choose the correct answer from the list without having to do anything else. But you can see which chapter is the source for each one of those questions if it is something you need to look up. The exercises, I do find it disappointing that you guys can't see how many points each one of these exercises is. How many points it's worth toward the 50 on the exam, but the exercises are worth more points than the multiple choice, because the assumption is it takes more work. You should get more credit for that. So all of the exercises in general will require you to use some sort of calculation in order to solve or find the answer. And so you've got petty cash questions. You have questions about calculating depreciation, cash receipts, more depreciation, different method there. More depreciation, different method, notes receivable, and a question about using the allowance method for uncollectible accounts. And so, excuse me, looking at those, then you can see that the exercises on the exam very much mirror the exercises in that practice set. So just like with the first two exams, I strongly recommend that you at least try that practice set on your own or attend the review session tomorrow morning to go through that for help. And make sure that you are well prepared for the exam before you try to take it. Okay, so questions, anything you want to talk about from those 3 chapters that are on the exam? Obviously, that's the most important stuff for today. If you do have questions, because a big part of your grade, each exam is 10% of your grade. So anything you want to talk about, review, anything else from those chapters 7, 8, 9 that are on the exam? Okay. I just want to point out the chapter 10 problem. So that won't be due until next Tuesday, but chapter 10 problem you can see on my screen right now is the second of the comprehensive problems that you're asked to do during the semester. So the first one you did after chapter 4. Remember, that was a little bit more work, a little bit more time and effort than was required for a regular chapter problem. So I'm just giving you a heads up that next week's problem, the problem on what we're covering this week, is also a comprehensive problem. And so you can expect that to take a little bit more time. It's also worth a little bit more toward your final grade than a typical chapter problem. Okay. So we are going to be picking up with chapter 10 since nobody wants to ask any questions this morning. Once again, for about the 3rd or 4th chat, Kenny. How do you sign up for the review session? I can't show you, but I can kind of tell you. So the question is, how do you sign up for the review session? So you need to get into Starfish. If you don't know how to get there, the easiest way to get there might be to go from the My JCC tab. You're going to sign in. Excuse me. You're going to sign in using the same. Oh, shoot. Sorry. Would not have that on the recording. I can't pull up Starfish. And if I can figure it out, I'll edit that out. That should not have been on the screen. Because that shows faculty stuff on there. So in Starfish, if you look at the 3 lines up on the top left-hand corner, if you click on those, you should see a link that says My Courses. And if you look at this course under that area, you should see a button that says something about review. If you click on that, you're going to be choosing the drop-in review session for Business 1510, which is this class. It might show you the option of 1520. That's not your class. So if you click on that, it should show you the option of signing up for tomorrow. It should also show you the options for the review sessions for exams 4 and 5. Those are scheduled as well. If you want to sign up for those now, you're certainly welcome to do that. But the one tomorrow, you want to make sure you're signing up for the review session for exam 3 on November 2nd. Did you find it? Really? Okay, so now that we have that starfish issue addressed, if you are planning to attend the review session tomorrow and it's not showing up to you as an option to sign up, please just send me an email and let me know and I can get you signed up on my end. I'm not sure why it's not showing up for everybody. It's definitely in there and it will be happening tomorrow morning. So we're now going to go to chapter 10. And just as I've done in the last few chapters, I didn't do a very good job of putting these in order. And so we're going to be skipping for now. We're going to be skipping the first exercise in the set. And in a moment, we'll be starting with our second exercise in the chapter 10 set. But first, we need to talk a little bit about the opening of chapter 10. So you can see in this chapter, we're going to be covering current liabilities, installment notes, and contingencies. I usually call this the current liabilities chapter, although it is possible for some of the concepts we'll talk about in this chapter, it's possible they could be more long-term in nature. But chapter 11 focuses on corporate liability, or excuse me, corporate bonds. And it used to be a little bit more encompassing of all long-term liabilities. So I still think of it as current and long-term, even though some of what we'll talk about in this chapter might be a little bit more long-term in nature. So you can see the learning objectives for this chapter. We'll be talking mainly about learning objectives 2 through 4, describe and illustrate. So that's where our focus will be. Learning objective 5, contingent liabilities. I would encourage you to make sure you read the textbook carefully about contingent liabilities and commitments. If something is contingent on something else, it means it might happen. If something else happens, then this might also happen. And so contingent liabilities are a little bit different as far as the accounting because of that uncertainty. We're not sure if this is going to happen at all. And so another example beyond product warranties might be of a contingent liability might be, we are being sued and we don't know if we're going to win or lose this lawsuit, but if we lose, this is what we believe the impact, the financial impact might be. And so again, there's a lot more uncertainty about that because it's contingent, it's dependent on some other outcome. So we talked about the term current liabilities for the first time back in chapter 4, when we introduced the idea of classifying the accounts on our balance sheet, of giving decision makers, users of those financial statements, a little bit more information than just here's how much we have or here's how much we owe for the assets and liabilities. A current liability then means that it is due or expected to be paid within 1 year or the normal operating cycle, whichever is longer. And that other piece that we threw in there is we expect to use current assets to take care of these current liabilities. That's why calculations like working capital and current ratio that we learned in chapter 4, that's why those particular calculations are useful or helpful for us, because we're comparing how much do we owe this year, how much do we have available to pay for it. And so knowing that difference in the terms of working capital, or that relationship, that ratio or current ratio, can tell us something about the liquidity of that company, the likelihood that they'll be able to pay their bills when they come due. In this chapter, that brief exercise number 1, the first exercise that I told you we'd get back to toward the end of this chapter, that would be on Thursday, that is going to look at some components of the current ratio, and that exercise is about the quick ratio, also known as the acid test. So it's not all of the current assets in the numerator, but it is comparing our financial assets, the things that are practically cash or already cash, to our current liabilities. You'll notice the fourth bullet point down on this slide says long-term liabilities are debts due beyond 1 year. But you have heard me refer to that rather than long-term liabilities. You've heard me refer to that sometimes as non-current liabilities. And the reason for that difference, that distinction, is because we may have some liabilities that are due this year, but we don't plan to use current assets to pay for them. And so that would take them out of the realm, out of the definition of long-term liabilities, and would raise the question, well, what do we do with them then? Where do we put them on our balance sheet? And so for that reason, it might be more appropriate, rather than calling them all long-term liabilities, to simply label them as non-current, which means they could be due this year, but we're using something other than current assets. And if you're wondering what else would you use to pay your bill, we'll talk about this, bring it up again in chapter 11 next week. But sometimes with a bond issue, for example, there might be a requirement, a covenant, that it requires us to set money aside to pay off those bonds when they come due. That's called a bond sinking fund. And so we might already have a pool of assets that are considered investments to pay off some of those liabilities. And so that's how one way it could happen, that we have something due this year, but we're not using our regular cash to pay for it. So we've been talking about accounts payable. You've known that term since chapter 1. Accounts payable represents the liability. Anytime you see that word payable, we know that means we owe somebody and we are going to pay them later. Accounts payable is typically used for our operating costs, such as buying merchandise from our suppliers, paying our other bills, such as utilities or wages, not accounts payable for that, excuse me, not for wages, but utilities or any other purchases that we make in the normal course of operations. If we buy something on credit, we would use accounts payable to keep track of that. In chapter 3, when we talked about accrual accounting and adjusting the accounts, we learned about other accrued liabilities such as wages or salaries payable, interest payable, other costs or expenses like that, that we have booked the expense, but we haven't actually paid the bill yet. And that's what an accrued liability would be. Our first exercise that we're going to do then is exercise 2. And as you may have noticed when I have that on the screen or on your own screen in front of you, exercise 2 is related to notes payable. I told you in the receivables chapter, in chapter 8, that we would be looking at in this chapter the other side of that concept of notes receivable. So if somebody is lending the money, someone else is borrowing the money. In chapter 8, we took the position of the lender, and we had a note receivable. In our first exercise today, we are going to take the position of the borrower. We are the maker of the note. We are borrowing the money we owe to someone else. And so what we're going to see in this first exercise is not really anything new in terms of the conceptual part of it, but we're recording the borrower side rather than the lender side of this action. And so let's go to that exercise. Exercise 2 in the chapter 10 assignment. Entry for notes payable. Bennett Enterprises issues a $600,000. So that $600,000 represents the amount that is being borrowed. That is the principal or the face value of the note. 120 day, that is the term or the maturity length of this note. 4% is the interest rate. And so we now have all of the required information to do the calculations we need for this note. They issued the note to Spectrum Industries for merchandise inventory. So what might have happened here? Bennett needed to buy a substantial amount of inventory Maybe the normal terms with with Spectrum are, they have to pay the bill in 30 days. And Bennett says, yeah, but we're not going to have the $600,000 to pay you in 30 days. So would you give us a little bit more time than that? And Spectrum says, how about 120 days? But if we're going to wait 4 months to get our money, we need to be compensated for that. We need to get a little bit of interest to pay us, to compensate us for the opportunity cost and the risk that we're assuming by letting you take a full 120 days rather than our typical 30 days. So in my scenario, and I'm adding to what's in this exercise, in my scenario, we're assuming that Bennett normally has 30 days to pay and that's not enough. And so they issue this note. Essentially, they're borrowing the money from Spectrum. And so, and we're asked, by the way, to use a 360-day year. I don't know why this book does that. I guess just because it does make the numbers a little bit rounder, a little bit more likely you don't have to round off. So we're going to use 360 days rather than what 365 days in a year. The first thing we're asked to journalize then in letter A, number 1, is the issuance of the note. So we are playing the part, we are doing the recording, the accounting for Bennett Enterprises. We are the maker of the note or the borrower. And so why did we borrow this money? It says for merchandise inventory. Spectrum delivered to us, allowed us to purchase $600,000 worth of inventory. And just as a reminder from chapter 6, we can tell that this company uses a perpetual inventory system because they're adding or debiting that inventory directly to the inventory account. If we were planning to pay under normal terms, say net 30, we would have credited accounts payable. But because we've issued a note, we've made a promise to pay interest on this purchase, we're going to add this or credit it to notes payable. Okay, so again, nothing new, but it's really the reverse or the opposite of the entry that Spectrum would have made that we would have discussed in chapter 8. Spectrum would at the same time be recording a credit to inventory and a debit to notes receivable. And now, 4 months later or 120 days later, Bennett's going to pay the note. And so at the time they pay, what's going to happen? Well, we're going to take the notes payable off our balance sheet because we're no longer going to owe that, right? And so we're going to take the note payable off our balance sheet. By the way, what we have there, transaction number 1 is what's referred to as a balance sheet transaction. Buying that inventory didn't affect our income statement. Issuing the note payable doesn't affect our income statement. Only at this point, when we pay that note, will it affect the income statement because we need to record some interest expense. I don't know yet how much. We have to calculate that. And the credit is going to be to what? We're paying the bill. And so we're going to use cash to do that. Now I need to calculate our interest. So again, back in chapter 8, we learned the simple interest formula. I equals PRT. Interest equals principal. In this case, the face value of the note was 600,000 times the interest rate given as 4%. Times the time. Now, if I just put in 120, that would mean 120 years because 4% is an annual interest rate. Excuse me. So I need to express that time as the part of the year. Divide by 360 since it told us to use a 360-day year. And so by my calculation, the interest due on this note is $8,000. And so at that time, we are going to report $8,000 worth of interest expense. And how much are we going to pay to Spectrum in total? The face value of the note, or the principal, the amount that we borrowed, plus the interest, or $608,000. I'm going to ask you to do part B on your own. I'll give you just a moment to do that. We already talked about what would the first transaction look like from the lender side or from Spectrum's side, so you should be able to do that. Interestingly, this is a little bit different than what I had said, because we don't have the entry. They didn't give us room. They didn't give us the information we would need to do the second entry for Spectrum when they receive the note, which is relieving their inventory. So based on what we have here, we can conclude that Spectrum does not use a perpetual inventory system. They reported the revenue, but they did not report removing that inventory from their records. And now, again, we're doing basically the opposite in part two. So Spectrum will no longer have a note receivable. They need to take that off their books and report the interest income and the receipt of cash. So not really anything that we haven't talked about before in that exercise, just good review as far as calculating simple interest and maturity value and so on. Questions on that exercise? All right. We will keep going. Our next exercise deals with what's called a discounted note payable. And I did make reference to this in the receivables chapter. A discounted note payable, essentially, we calculate the interest up front and we discount. So what does it mean if you put something, if you discount something, it's kind of like putting it on sale, right? You lower the value, you lower the price. A discounted note payable means that the borrower does not receive the full face value or the principal. The interest is calculated based on that face value, but then the interest is subtracted. And so for this company, issuing a 60-day note for $60,000 to the bank, they wouldn't receive the full $60,000. We're going to calculate the interest on the $60,000, but they don't actually receive that full amount. And I remember when we were talking about this in chapter 8, I had pointed out that if you are the borrower, you would not want a discounted note. You want to receive that full face value. If you're the lender, it's a better deal for you to discount that interest, because essentially you're paying interest on the full $60,000, but you never receive the full $60,000. So you're paying interest on more than what you received. It makes your effective interest rate a little bit higher. Good for the lender, not good for the borrower. So again, we need to do the simple interest calculation. So go ahead and do that. and I found simple interest of $800. And so by discounting the note, that means that the borrower doesn't receive the full 60,000. They receive 60,000 minus 800 or $59,200. The amount they have to repay. Oops, hang on. Surprised they gave me that line. There it is. The amount they have to repay is the full 60,000. But 800 of that represents the interest. And so this is different than what we did in the previous exercise because the interest is included in that face value. We discount the note or we subtract that interest out before we calculate how much the entity is borrowing, the maker of the note is borrowing. When we repay it then, as I already said, we have to repay the full 60,000. So in another way of looking at this, in a discounted note, the interest is included in that face value. And as I said, it does make the cost of borrowing slightly higher. The effective interest rate is slightly higher. So if you are borrowing and you have the option, whoops. Says they're issuing the note to a bank. So I assume that they were borrowing cash. Doesn't say what they're borrowing it for. Yeah, so this is in the check my work feedback. Why is the company issuing the note? It doesn't tell us why they're issuing the note. I assume that they were borrowing cash. But let me just see if it likes this better. Okay, so poorly written exercise, in my opinion. It doesn't tell us what they're borrowing that money for, but based on what they're counting as correct, they're borrowing it to pay off some other liability in accounts payable. It doesn't tell us that. I don't know how we're supposed to know that, but I didn't write the exercise. Okay. So back to what I was saying, if you have a choice, if you are the borrower, you would not want the discounted note payable because it does increase your actual cost of borrowing, the effective interest rate. Any questions about that? If you're wondering which of these is more common, the non-discounted note, like we did in the first exercise today, God bless you, is much more common. All right. Questions, anybody? Keep going. So when we think about what a company is including on their financial statements, and I already told you our next chapter, the chapter we're going to cover next week, deals almost exclusively with corporate bonds. That might even be the title of the chapter. And corporate bonds are, without giving you too much information that's for next week, corporate bonds are generally issued long-term liabilities that might be for 5 to 20, 30, or even 50 and 100 years in duration. And so a company might have long-term debt that has portions of it that are maturing or are due this year. And so each year as they prepare their balance sheet, they're going to be looking at what makes up that long-term debt and calculating how much of that debt is due within 1 year. That debt may have been outstanding for 5 or 10 or 20 or more years. And only in its final year, when it's actually going to be due, does it become a current liability for us. I want to see if I can quickly show you something here. I'm just pulling up Pepsi because that's what's in this exercise. So what I'm pulling up is Pepsi's annual report. The most recent one available for Pepsi is 2021. And you can see it's almost 150 pages long. So as I have suggested to you, here we go. Make this a little bigger so people can actually see it. Okay. And so usually we have to go about half to 2/3 of the way through the annual report before we find their actual financial statements. And so here's their income statement, statement of comprehensive income, cash flow statement, continued balance sheet. Okay. So as I look at Pepsi's balance sheet, we can see that under liabilities, they have long-term debt obligations. And at the end of 2021, that was 36,026. These numbers are in millions. So that would be $36 billion that Pepsi owed at the end of 2026 or 2021, excuse me. Down from 40 billion the year before. So I guess they're making progress on those long-term debt obligations. But during the year, as potentially some of those liabilities get to the point where they're due in less than a year, they would be reclassified or restated on their financial statements. They've moved from being a long-term liability to a current liability. And based on what I see here, I would suggest that those long-term liabilities, if they have any due this year, they've moved into the short-term debt obligations. Now, the reason I wanted to take the time to do this is because as you are working a couple weeks from now, as you are working on part 4 of the project, you are going to be asked to look at this same information for your company. And what you are asked to find then is a listing of their long-term liabilities. And so I just want to show you where you might find that. So as I've explained in class, as I've said to many of you in my feedback on your annual report project, you need to find the financial statements like I just found in Pepsi. And immediately following those is their notes to the financial statements, which is what's showing on the screen right now. So note 2 is note 1 or 2 is usually their significant accounting policies. So here Pepsi's is in note 2, but I'm just going to keep going. Hopefully I'm not making anyone sick to your stomach. Close your eyes or turn away if you need to. I'm just scrolling down and I'm looking for information about their long-term liabilities. So income taxes, stock options, long-term cash, pension, pension, something that's going to come up. Here we go. Note 8, finally, page 105 of 149 is their debt obligations. And you'll notice that these numbers down here at the bottom might look a little bit familiar. These are the exact numbers that we just saw on their balance sheet as their total long-term debt. But you can see that details when those notes are due. So there was a note that was due in 2021. So in 2020, it was a long-term liability, and then it became a current liability because they had to pay it off in 2021. These percentages listed after that are the interest rates that they're paying. The interest rates that they are paying on those notes. And so you can see that they have a couple different notes due in 2022, 23, 24, 25, 26, 20. And then they have some that are due out as far as 2060. Another 40 years before those final notes are due. So when you are working on your annual report project that covers long-term debt, so that would be chapter 11, it's going to ask you about what your company discloses. This is where you're going to find it. It will look very similar to what you see here. Corporate bonds are the most common form of financing for a publicly traded company. And so the vast majority of companies that you guys have chosen for your project are going to have a disclosure in their notes that looks very similar to this. What I would recommend that you do for that project is, if it works, to just copy this and paste it into your Word document. That would be great. If that doesn't work because of a formatting issue, what I would suggest is maybe you use your snipping tool to just take a snip of it out of your annual report. If you need help with that, I'd be happy to help with that. But I suspect you all know how to do that or can figure it out. Okay. So I just wanted to show you this so that you can see how companies disclose that, because that, you know, the numbers are not going to match up because I don't know what year this was from. But going back to our exercise then, it gives us information about Pepsi and their long-term debt from a recent financial statement. This could have been from several years ago for all I know. It's probably intentionally not specific about that. But any questions about what I just showed you, how to find that for your company or anything else at this point? You will need that. Okay, so what we're seeing here is a summary, although the numbers are different. It is a summary based on what Pepsi had in their annual report. The total long-term debt, the part that's due this year, and this is their actual long-term debt, or the non-current portion. So letter A asks, how much of the long-term debt was disclosed as a current liability on the current year balance sheet? So how much of their, on the current year, how much is disclosed as a current liability, which is our focus for this chapter? What number? Thank you, 2848. So $2,848,000,000 as of this date, Pepsi was going to be paying off in that current year, almost $3 billion. That was money that had been borrowed more than a year ago. How much did the total current liabilities change between the preceding year and the current year as a result of the current portion of long-term debt? So last year's was 3953, and this year's is only 2848. So the difference is 1105, and their current liabilities actually went down because we don't owe as much this year. You'll notice our total liabilities, total long-term liabilities went up. We had paid off, assuming we met all of our obligations. Last year we had paid off 3953, but our long-term debt actually went up during that period. And so we must have issued more debt. Letter C says, if PepsiCo did not issue additional long-term debt next year, what would be the total long-term debt on December 31st of the upcoming year? So again, we just went through, they did issue more long-term debt this year. Even though they paid off almost $4 billion, their total long-term debt went up by almost $1 billion. And so they must have issued about $5 billion more and paid off $4 billion. So their net or their total changed, as you can see. And so if they didn't do anything else next year, right now they owe $29,148. If they pay off the $28,448 that's current this year, what would be the total long-term debt next year? It would just be the amount that's left if they didn't issue any more debt. If they didn't issue any new debt and they paid off the current portion this year, next year they would only show the $26,300. And I don't know, I can't tell from this how much of that might be current next year. But if we were looking at this level of detail, we could figure that out because we can see how much is due each one of those upcoming years. And so that's an important knowledge and important skill to understand is how do I read this? What is this information telling me? Again, on their balance sheet, we only see these two big numbers. But if you're thinking of, I don't know, maybe lending money to Pepsi, you'd want to know what's the chance they can actually pay me back? What risk am I assuming? Well, let's see how much they've already borrowed and when they're going to have to pay that back. What are the chances they're going to be able to pay me back if I'm going to put another word here on the screen for you. Subordinated. Okay. So subordinated debt, sub means under. And so if this debt is already outstanding and we lend them some more money, our debt is likely subordinated to these that already exist. If Pepsi runs into financial difficulty, if they can't pay someone, it's going to be the later issued debt that gets paid off after the existing debt. It's kind of like, if you have any knowledge about this, if you take out a mortgage on your home and then you take out a second mortgage, if you default on that mortgage, if they're taking your assets to pay off those liabilities, they're going to pay off the first mortgage first. And then if there's anything left, they would pay off that second mortgage. So understanding how to read this can be very valuable, can be very important if you are trying to make a decision about this company, about whether to lend them money, for example. Okay, questions at this point? Anybody? Okay. Keep going. And let me let's talk about payroll next. So for many or most companies, payroll is the single largest expense that they have. If you look at their income statement, payroll can be their single largest expense. And now I'm curious if I can show you this since I have this open. Let me just go back to their income statement. We'll see if that's true for Pepsi. Seriously. Well, unfortunately, it doesn't give us enough detail here. Sorry. I will point this out because this is going to come up in this chapter as well. You'll notice that they have a separate line item for other pension and retiree medical benefits. You'll notice how much that has cost them. In 2021, they spent $522 million on recording future payments that will be due for current employees. And we'll talk about that later. So since that's their interesting topic. Okay. So unfortunately, I can't give, there's not enough detail for me to show that to you, but single largest or one of the very largest expenses for virtually all companies is their payroll. And so it's important that we do it right. There are reasons, we want to keep our employees happy, so paying them what they actually have earned is important. But it's also very important that we get the tax piece of it, the statutory or the regulatory piece of it correct as well. So we're going to be spending a good amount of time today talking about payroll, in part because I think that many people, even though most or all of you have probably had a job, maybe have a job right now, I know that there's a lot of intricacies related to payroll that even people who've worked for years may not recognize or understand. So I think it's important that we all talk about what goes into payroll calculations. I think this term has come up before, the difference between salary and wages. So salary is the term salary means you are paid for performing a job regardless of how many or how few hours you work in a given week. Your pay is the same. Wages are paid by hour, so hourly wages. If you know, for example, you're getting paid $15 an hour, you are getting wages, not salary. There is a statutory requirement that if you pay a worker a salary, but it's less than, for this year, it's around $53,000. If your salary is less than that, you also are eligible for overtime on being paid on that salary, in addition to that salary, I should say. And that the term is referred to as exempt or non-exempt employee. You can see there, and you're probably all aware of this, 1.5 times the regular rate for all hours worked in excess of 40 hours. There's the term exempt. And so I just told you that exemptions may be provided for some positions, exemption from that overtime requirement, but the law currently states that if your pay is less than that, about $53,000, you can't be considered exempt. You are a non-exempt employee automatically. Some companies may, in addition to that, that requirement for over 40 hours that you are paid overtime. Some companies may decide that you get paid overtime for anything over 8 hours in a given day, regardless of how many hours you work that week. Some companies may also pay something like double time for working on a Sunday or on a holiday, something like that. As we are looking at a payroll calculation, you've heard me use that term gross before. We've talked about gross receivables, meaning the total. And so the term gross means total. Gross pay then means the total amount that you have earned in that pay period. But if you've ever had a job, you're all aware that net pay is the amount that actually lands in your bank account or lands in that check if you receive a hot check from your work. So the difference between gross pay and net pay is referred to as the deductions. And you can see on the final bullet point on this screen what some of those deductions might be. federal, state, local income tax, medical insurance, pension, any other retirement contributions, or anything else that you guys know of that might be withheld from your paycheck? I can think of a couple others that you might be subject to. New York State has a couple. If you work in New York, has a couple that you probably see on your paycheck. Anyone know any? Can you think of any? You guys don't pay that close attention to your paycheck? No. No, wow. So others that you might be subject to in New York State include paid family leave, disability. If you are represented by a union in your workplace, you might see union dues or fees being subtracted from your paycheck. You might voluntarily have additional money taken out of your paycheck for, say, charitable contributions to United Way, or here at JCC, we have the option of donating to the JCC Foundation. So any of you who might be receiving scholarships from the JCC Foundation, such as the USA Scholarship, I'm not going to ask you who you are, but I suspect there might be at least some in here who are receiving that scholarship. Those scholarships are funded in part through payroll deduction from JCC employees. So if you aren't paying close enough attention to your paycheck to recognize these withholdings, I would encourage you to take a look at that the next time you receive a paycheck. Or if you only pick up your stub online, again, I would encourage you to take a look at that. So how does the company know how much to withhold from your paycheck? Well, when you start working for a company, you're going to complete it. And I need to make a comment here. What I am talking about in all of this is what I would call legal employment. So if you are being compensated under the table, I'm putting that in quotes, you should recognize that what you are doing is illegal. You are breaking the law by doing that. You have a requirement that you pay tax on every dollar that you earn. So the under the table employment, the cash payments that you receive are illegal if you are not reporting them and paying tax on them. So everything I'm talking about here refers to legal employment. I have a couple stories I'm going to share with you that I've heard from students through the years, and maybe it will highlight for you why I think it's important that people understand how your taxes are calculated, why your deductions are what they are on your paycheck. Because I think personally, I think that people have an obligation to be aware of what it is that you're paying, and when you don't even look at the payroll stub, you probably don't know these things. So a couple stories. One, many years ago now, we were having a conversation in accounting class, but it was after class. We had a couple students who stayed after working on an assignment. And one of the young ladies, her name was Sarah. Sarah said to me, as we're looking at an income statement, and the bottom line was income tax expense, and the exercise said something like, assume that the income tax rate is 30% or whatever. And Sarah looked at me and she said, do you mean that companies have to pay taxes based on how much money they make? And as a business instructor teaching a business class to business majors, I was a little taken aback. I said, yes, Sarah. And so do you. Have you ever had a job? And she said, oh yeah, I worked at the candle factory last summer. And this was the spring semester. And she had worked at the candle factory over the summer. And I said, well, did you notice? So I was trying to establish that it was a legal job. And it was. I said, so did you notice that when you got your paycheck every week or whatever, that You know, there'd be a line that would say like how many hours you worked and what your hourly rate was, and then the total amount that you would earn, which was your gross pay. And then there was a list of some other amounts, and then there was the amount that you actually received in your check. And she said, yeah, I wondered what that stuff was. It was spring semester, so personal income taxes were due, and I, explained to her she needed to go home and have a conversation because she probably had money withheld from her check that she didn't actually owe and could get refunded to her, but she had to file her taxes. That particular student happened to live in Pennsylvania, and Pennsylvania, anyone live in Pennsylvania? Or work in Pennsylvania? So Pennsylvania has a flat tax. And unlike New York and the federal system, a flat tax means that you pay the same percentage. Well, a better word for that is, rather than flat, a proportional tax means that you pay the same percentage of your income regardless of how much you make. And so let me put some more words here on the screen. So there are 3 different types of tax structures. And I'm just going to list them out here to the side. There is progressive, proportional. I'm going to put flat in parentheses, but that's a little bit of a misnomer. And regressive. So a progressive tax means that higher income earners pay a higher percentage of their income for that tax. A proportional tax means that everyone pays the same percentage of their income as that tax, regardless of whether they're high or low income earners or somewhere in the middle. Regressive taxes are taxes that hit lower income earners harder. That is, they pay a higher percentage of their income as that tax. Federal income tax, New York state income tax are progressive. The higher your income, the higher percentage of your income goes to pay that tax. Medicare traditionally has been proportional, but I'll talk about that again in a minute. And things like sales tax are actually regressive. That lower income earners pay a higher percentage of your income for sales tax than do upper income earners. If you're thinking, well, how can that be? They don't ask me in the store how much money do I make and tell me what my tax will be based on how much I make. Of course not. But lower income earners spend more of their earnings on sales taxable items, where upper income earners are more likely to be spending some of their income on things like investments that are not subject to sales tax. And so sales tax, even though everyone pays the same percent of the item that you buy, everyone pays the same percent tax. Lower income earners are more likely to buy more sales taxable stuff, or a higher percentage of their income goes to buy sales taxable items. Does that make sense? So everybody okay with what these 3 words mean? I'm going to be using these 3 words as we talk about the different types of taxes that are part of the payroll tax concept. Everybody okay with those? Okay. So when you start a legal job, you are asked to complete a W-4, and there's an example of a W-4 on the next screen. If I can get the screen to change. And so this is an example of a W-4, although yeah, that's from 2019. That might be the newer one. So it's been updated with the changes to our tax system from 2018. And so basically what you're indicating on that W-4 is how many people are dependent on you. And so this has changed with the 2017 tax reform that took effect in 2018, because the concept of dependence has really changed, at least at the federal level. But you fill out this form and you're telling your employer, basically, here's how much I want withheld, based on the number of people who live in your household or the number of people who are dependents on you, as well as whether you have 2 jobs in your household, whether you personally have 2 jobs, whether you need additional withholding taken from your paycheck. Okay. That withholding, okay. That withholding normally I would have these up before class and I just didn't think of it before class today. So that withholding, that information from your W-4 in conjunction with what I have on the screen right now, which are, you don't have to read any of the numbers. If it's too small, that's okay. I just want you to get the idea that based on your filing status, so whether you are single, married, married filing separately, widowed, head of household, depending on your filing status, how many people, how many allowances you claimed on that W-4 and your income and how often you get paid. So there's a different withholding schedule based on each one of those things. How often you get paid, what your filing status is. You can see each, even if you can't see the numbers. Over here on the left-hand side is how much did you earn in this pay period? So this is a monthly payroll period. There's separate brackets if you get paid weekly, bi-weekly, semi-monthly, monthly. And you would find, so if you were filing as a married person, married filing jointly, and this is a monthly pay period, if your pay was between $32.25 and $32.85 for the month, and let's say you had 4 allowances, they would withhold $74 from your paycheck for federal taxes. You can imagine how complicated this gets if you have people who are paid, some who are paid every week, some who are paid every other week. Every single person has a different W-4, a different number of allowances, a different pay. Using these manual forms like I have on the screen right now are incredibly complicated and really easy to get it wrong. That's why most companies outsource their payroll. They hire a company like Paychex or ADP to handle their payroll for them to make sure it's right, to make their employees happy, and to keep the government entities happy as well. As I already indicated, federal and New York state taxes are progressive. And so the higher your income, the higher a percentage of your income is going to be withheld to cover your eventual federal tax liability and New York state tax liability. So that's withheld from everyone's paycheck unless you are exempt. And that W-4 gives you the option of claiming that you are exempt from federal tax. And basically, if you didn't owe tax last year and you don't expect to owe tax this year, you can be exempt from withholding. Another payroll deduction that you will see on every single employee's paycheck is for FICA. You can see what that term stands for, Federal Insurance Contributions Act. It is an act of Congress, and it includes both Social Security and Medicare, although you're likely to see 2 separate lines on your paycheck. One of them might be called FICA and one might be called Medicare. Medicare is part of the same act, they're part of the same legislation. But again, they report them separately. Social Security is withheld at a rate of 6.2% per year. Now the textbook, because they like us to round, the textbook generally tells us to use 6%, but you should know that the actual rate is 6.2%. It has been 6.2% for decades, other than 2 years in the middle of the 2010s, where there was a reduction from 6.2 to 4.2%. What you may not know is that while you very well might, I hope that you are aware that Social Security is withheld from your paycheck. What you may not know is your employer also makes payments to Social Security that match your payments. They make them on your behalf. So if you have $5 withheld from your paycheck, that goes to Social Security. Your employer pays another $5. So the total contribution for you is $10 for that pay period. And I don't think people recognize that. Over the years, I've asked, and most of the time people are not aware that that happens. Social Security has a cap, though. Social Security has a cap. It has a maximum that you can be required to contribute in any calendar year. And so you can see that in 2023, next year, that cap will be $160,000. This year it was $147,000. Not too long ago, it was about $110,000. It goes up each year. It's somewhat indexed for inflation. What that means is once your earnings for the year, for the calendar year, reach that amount, Social Security deductions stop. If your earnings reach that amount from a combination of jobs, each job has to keep collecting from you, but you would get that money refunded to you when you file your federal income tax the next year. And so there is a cap on that. It's called the Social Security wage base. There is a cap on Social Security. So everyone pays 6.2% up to that cap. And so that sounds like a proportional tax as the way we described it. But because upper income earners stop paying that, Social Security is actually a regressive tax. Because anyone who's under that wage cap pays 6.2% on your whole income, and anyone above it, your average Social Security then goes down because you stop paying Social Security on wages above that point. Social Security is only on earned income, so it's not on investment income and things like that either. Okay, so 6.2%, you pay 6.2%, your employer pays. Those 2 years, it was like 2013 and 14 or 12 and 13, can't remember now. When it was lowered to 4.2%, the employer was still paying 6.2%. But employees, in an effort to spur the economy, to grow the economy, they were trying to cut taxes, but they recognized that at that time, about 50% of people didn't pay federal income tax. So you can't cut a tax that people aren't paying. So one thing that everyone pays is Social Security. And so they cut the Social Security rate for those 2 years. Obviously, it was temporary. Okay, so everyone has Social Security withheld at 6.2% until you reach that cap. Medicare is withheld at a rate of 1.45%. Again, the actual rate is 1.45. The book will tell us in our exercises to round that and use 1.5, but the actual rate is 1.45. Just like for Social Security, your employer matches whatever's withheld from your paycheck for Medicare is also paid in, matched by your employer. Unlike with Social Security, there is no wage cap on Medicare. So every dollar you earn is subject to that 1.45% Medicare. In fact, since the Affordable Care Act was passed, there has been a Medicare surcharge for upper income earners of 0.9%. So Medicare, where it used to be proportional, everyone paid the same. It is now a progressive tax because upper income earners are subject to that extra about 1% of their income being paid into Medicare, the surcharge. for Medicare that was part of Obamacare or the Affordable Care Act. So Social Security regressive, Medicare proportional, somewhat progressive now with that surcharge. In case you're wondering why there's a wage cap on Social Security, the reason there is a wage cap is because there's also a cap on the benefits, and Social Security was designed to be a you pay in, you get back, as opposed to an entitlement program using that terminology. Social Security is you pay in, you get back. So if there's a cap on the benefits, it makes sense that there's a cap on how much you're required to pay in as well. There is a connection between those two. Other deductions, I mentioned many of these: union contract for union dues, retirement savings, charitable contributions, life insurance. There are 7 states that do not have a state income tax, but most states do have a state income tax. And so you would see that withheld. With what we're doing in class, we're not going to be looking at any state income tax because it is different for each state. But for those of you who live and work in New York State, our state income tax system models that of the federal government. It is progressive, and it does start with the calculation on your state income tax in New York State starts with what did you have on your federal return. So you prepare the federal return first, and then your state return starts with that federal calculation. So I think at this point, we'll go back to our next exercise. And this may be all we have time for today. And which exercise is this? So this is exercise 5 in chapter 10, computing payroll. So we've already talked about the concept of salaried versus wages, being paid by the hour, people being eligible for overtime or not. So the statutory requirement that people be paid overtime doesn't mean that employers can't be more, I don't like this word, but I can't think of a better word, more generous than that. Employers may decide to offer overtime that exceeds the statutory requirement. And so this computer programmer who's being paid $55 an hour is being paid 2 times the hourly rate for overtime. That is exceeding the statutory requirement. But if you as the employee work out that agreement with your employer, that's great. More power to you. For hourly employees, overtime is paid for hours worked in excess of 40 hours per week. For the current pay period, the computer programmer worked 46 hours. So that person is going to be paid 40 hours of straight time and 6 hours of overtime. And the administrator worked 50 hours. So that individual is going to be paid $70 per hour for the first 40 hours and time and a half for the next 10 hours. As I already pointed out to you, the exercises ask us to round Social Security and Medicare, just so that we don't have to deal with all of those decimal places. But I do want you to be aware of the actual percentages. Use the percentages that are provided in the exercises or on the problem or on the exam when it comes to that. But I want you to know that Social Security is 6.2 and Medicare is 1.45. So we're asked to find the gross pay and the net pay. And the only thing we're asked to subtract from that is Social Security and Medicare. It also gives us the federal income tax that is going to be withheld. I explained to you the complications of calculating that. Depends on how often they're paid, what their filing status is, how many allowances they have, and what their gross pay would be for that pay period. So luckily, we don't have to do those calculations. We don't have to use these kind of tax tables to to calculate that number, but you should be aware of where those numbers come from. So let's start with the consultant. The consultant is paid a salary. And so his or her gross pay is $6,000. It doesn't matter how many hours that person works. Their pay remains the same. I'm going to add a couple columns down here, just as a reminder for us. So Social Security and Medicare and federal income tax. So we'll start with Social Security for the consultant. We're using that 6% figure. And so the consultant would have $360 withheld. For Medicare, again, we're using that rounded figure of 1.5%. And so the consultant would have $90 withheld for Medicare and $1,380 for federal income tax. So to find that individual's net pay, we simply subtract the 3 withholdings that were given. Again, we recognize that many employees have additional withholding beyond that: state income tax, union dues, retirement plans, or voluntary contributions for retirement plans or benefits. You might have some part of your health insurance that you're required to pay, and so on. Everybody okay with that? That one's the easy one because that person is salaried. For the computer programmer, though, we need to do a little bit more work to calculate that gross pay. And I'm just going to put the calculation down here on the bottom. So it's $55 an hour for the first 40 hours, plus 2 times that for any hours exceeding 40. So the computer programmer worked 46 hours and is eligible for overtime for the final 6 hours then. So $55 an hour for the first 40 hours plus 2 times 55 for the next 6 hours. So I did my math correctly. The computer programmer earned gross pay of $2,860. But we need to subtract from that the Social Security at 6%. And it says to round our intermediate calculations and final answers to 2 decimal places. Medicare at 1.5%. And the federal income tax is given as $452. I know we have about 1 minute left, so I'm going to ask you to finish up this exercise on your own. You're welcome to stay and do that if you'd like. I'm going to finish mine up on the recording as well. And when we come into class next time on Thursday, I would be happy to answer any questions, but I will assume we're ready to move on to exercise 6 and keep going with payroll at that time. All right, hopefully you'll be able to join me for the review session tomorrow, and I'll see you on Thursday. And so on the 3850, we're going to calculate 6% Social Security. And 1.5% for Medicare. And then their federal income tax. So our final calculation for this exercise, we take the gross pay and subtract the 3 withholding amounts shown there. And round to 2 decimal places, 29, 19, 25. All right, and that is the end of our class for today.